on today's CPI as well as IIP data releases. I'm joined by Subhadeep Rakshit, Senior Economist at Kotak Institutional Equities, and Rajni Sinha, Chief Economist at CareEdge Ratings. Thank you so very much to both of you for taking time out for us today. So, Subhadeep, I'll start with you. A quick overview of what your expectations from today's figure, and we're likely to be seeing a slightly higher than expected figure. We'd seen a print of about 4.75% in the last month for May. This time around, it's expected to be a slightly higher figure on account of vegetable prices. Is that broadly in consonance with your view?
Absolutely. In fact, when we were looking at the numbers, when the May numbers were released, taking into account the June numbers for the first couple of weeks, the print was actually going to be for June around 4.3, 4.4%. And I think that is the number to look at, that inflation was supposed to come down slightly from the 4.7% in May. But instead of that, we will be closer to 5%, maybe slightly above 5%, depending on how the vegetable prices collection has been and in what period it has been, because the price increases in vegetables happened during the last couple of weeks of June. So it should be higher than, definitely higher than May and closer to 5% in June.
Okay, the headline figures for IIP coming in at about 5.9%. That's for the month of May. Rajni, your quick thought on just the headline figure. That's all we seem to have for now. The breakup coming on the screen as we speak. But given the recent prints and given the Bloomberg estimate of 4.9%, the IIP print is a little bit of an upside surprise.
Absolutely, Pallavi. Our expectation for IIP was around 5%. So it is higher. The most important thing which I would be seeing in the breakup is as to what has happened to IIP consumer non-durables. Because it is very, important to track as to whether consumption is really recovering in the economy. This whole thing that we are talking about, monsoon and rural demand recovery, it will be important to see whether it's getting reflected in non-consumer durables good also improving. So that's something important which I'll be watching out for.
The headline CPI print coming in at 5.08% for the month of June. The Bloomberg estimate was at 4.8%. So this is a tad higher than what was being estimated as well. And this is after we've seen months of a consistent downtick in the headline print. In fact, pretty much through most of 2024. So this is the first higher print that we're seeing this month, though again not entirely out of line with expectations. Rajni, quick thoughts on the headline CPI print as well?
So again, our CPI inflation expectation was lower. We were expecting around 4.8%. Definitely, it would have happened because of sharp increase in vegetable prices. Because if you track closely the vegetable prices, even prices of items like potato, onion, tomatoes, there have been very sharp sequential increase that has happened in the last month, in the last 1 month. So this is on expected lines, but yes, it's a little higher than what we were expecting.
Right. Subhadeep, coming back to you, given that we have seen a fairly sharp spike in prices of key perishables, potatoes, onions, tomatoes, for instance, would it be fair to say that we actually can't expect any deacceleration in prices immediately? And if anything, we might actually see some further upside to prices as well. What's your view on the prices of key perishables going forward? Is there respite in sight? Is it hard to say? Or is it only in the next few weeks or possibly in the next couple of months that we'll actually see any easing in prices there?
So if you look at the July 1st week prices, vegetable prices have slightly softened. But typically, these are 2 to 3 month crop cycles. And if you have any kind of disruptions in the crops, let's say in a particular month, it takes usually a couple of months to kind of settle back to where they were. We've seen this play out sometime last year. It took around 3 to 4 months to kind of reverse completely. But this reversal will happen. It's not as if this is this is not like a durable shock to inflation or food inflation, to be more particular. So this will reverse, and possibly in the next 2 to 3 months, we should see these prices soften. And assuming that the next set of crops or the next crop cycle is normal and there are no shocks in that. So in that sense, you should expect somewhere around September onwards, you should have the reversal in the crop prices.
Okay, all right. So a reversal in prices likely, but immediate relief might not be there. We might see some relief on prices of key perishables, most importantly vegetable prices, softening only towards September when we see fresh market arrivals. But Rajni, coming back to you, so far it seems to be a bit of a wait and watch mode, given that we did see the southwest monsoons deficient in June. In July, we have seen a pickup nationally as well as regionally on the southwest monsoon front. What is it that we're going to be watching out for over the next few months? How important is it for rainfall to continue to recover? How much of the inflation trajectory appears to hinge on it? So far, what are the sowing and harvesting trends indicating?
So, like you mentioned, if I look at overall monsoon performance in July, it has improved compared to what we were seeing till June. So now we have a 2% more than the long period average. It's a little early to say as to what to expect going forward. But if we go by IMD projection this year, monsoon should be good. If we look at the trend so far in terms of sowing, it is good, but again, it's a little early in the first week of July to say, and July would be the most critical month. See, this year, overall monsoon will be very critical for agri production and for food inflation, because this is on the back of a bad monsoon last year. So agri production in the last crop cycle was adversely impacted. We already have high food inflation. The reservoir levels are already low. So in that sense, while monsoon is important for agricultural sector and Indian economy, but this year it's even more important because of the fact that last year was not good. And apart from inflation, we are kind of waiting for rural demand to improve, and that will be contingent of what kind of monsoon is there, what kind of food production, and how food inflation softens. So a lot of factors would be dependent on this year's monsoon.
Okay, got it. Right. Please carry on.
Just one thing I'll add that, Pallavi, but yes, in the next 2 months, inflation is expected to go down because of base effect.
Okay.
But again, we are expecting it to start increasing after 2 months.
Oh, is that the case? And why is that? Is that because of waning base effects post the next couple of months?
So yes, it is because of waning base effect. And it's mainly because of that, because otherwise we have assumed that food inflation is going to moderate in the next few months. And that's based on the assumption of a normal monsoon. So if that's the case, we could see some comfort on food inflation going forward in the next few months.
Okay, all right. Before we move on, we'll also take a quick look at the breakup of the CPI print. Cereals and products inflation has come in at 8.75% for the month of June, while inflation in vegetables is at 29.3%. Oils and fats continued to see a deacceleration, while pulses and product prices rose by about 16.1%. Food and beverage inflation came in at 8.4% for the month of June. Clothing and footwear prices rose by about 2.7%. Housing inflation came in at 2.7% as well. Fuel and light continued to see a contraction and it contracted by about 3.7%. Among the other key monitorables, we also saw inflation in health at about 4%, while personal care and effects was higher at about 8.2%. So Pradeep, coming back to you, broadly, these figures are in line with expectations, though the rise in vegetables might be a tad higher than was being estimated, and that might have pushed up the headline figure too. Is that right?
Yeah, broadly, that is correct. I mean, I think the main difference has been in terms of the vegetable prices, maybe pulses prices a bit. But I don't think any other components will be way off our estimates. We were looking at 5% inflation, so I think broadly we are in line with most of the items. And in terms of the surprise, obviously it has been from the vegetables, clearly.
Right. Okay. Coming back to cereals as well as pulses, we've seen, and of course, while that figure is still fairly low compared to, the spikes we've seen in vegetable prices, for instance, we've seen very elevated and continuously elevated inflation in case of cereals as well as pulses, unlike vegetables, which does tend to be a lot more cyclical and volatile. So given that, should we continue to expect supply side interventions? And also, given that we've seen these prices stick on for quite a while, when are we expecting some consistent de-acceleration in prices of cereals as well as pulses? So, Pradeep, you can go.
Okay, so in terms of when you're looking at the cereals, obviously there was a more durable shock to cereals, starting with wheat prices, and then subsequently we had rice production, which was slightly lower than expected. So we have seen some structural shocks to it. So the cereal prices have been elevated, but if you look at the kind of trajectory in terms of the year-on-year inflation, that has been softening. In fact, we also have a metric that we kind of follow in terms of durable food inflation and more volatile food inflation, where the volatile components are more like vegetable, fruits, etc., and durable being cereals, pulses, etc. That particular component has been coming off over the past few months, the durable part of food inflation, which has long cycles in terms of shocks. Once a shock is given to a particular food item on the durable side, the cycles are much longer than, let's say, something like in vegetables or fruits, which are the short cycle crops. So in that sense, I think it's not as if prices are increasing rapidly every month. I think the pace of increase has come off. And from a year-on-year inflation perspective, they are also starting to soften. So I think we should be comfortable on that front, barring any risks in terms of shocks coming in terms of sowing, etc. Just on the sowing part, early signs till early July, we have good set of sowing numbers on the Kharif side. So rice, pulses, etc., are showing good year-on-year increases in the acreage. So that's a kind of a positive that we should be looking at in terms of implications on the food inflation.
Okay, all right. Coming back to you, Rajni, so you did say that headline figures could see a little bit of a rise a couple of months ahead, though vegetable and food prices in turn are likely to ease. What about core inflation? At some point, do you think core inflation has sort of bottomed out? Are we likely to see some upside on that as well going ahead?
Yes, Pallavi, as per our projection, we are expecting core inflation to start inching up in the next few months. But I would say that's more of a statistical play. I still don't see the demand side being so strong as to worry about core inflation. So I think RBI will continue to worry about food inflation. So as long as if food inflation turns out to start moderating going forward with good monsoon, I think that will bring quite a relief to the central bank, even if overall inflation continues to remain above the 4% target.
Okay, all right. Suvati, before we can shift focus a little bit, one last question about the central bank, and given the commentary that's come in from the MPC and especially the RBI members, given Governor Das's insistence on reining in inflation before the central bank and the MPC consider a rate cut, can we say that a rate cut has been pushed forward to possibly December or maybe even early next year? How are you viewing it?
So in terms of looking at inflation and the impact on the or the reaction of the RBI, I think it should be clear that when the target is 4%, right? And if growth is supporting in terms of the growth numbers are not way off in terms of the RBI's estimate, the focus on inflation should continue. In fact, one of the ways to think about it is that between concerns on inflation versus concerns on growth, if the concerns on inflation are overweighing the concerns on growth, then obviously the RBI should be cautious and kind of keep on targeting the 4% mark. So to that extent, till the time there is visibility of a 4% mark being achieved durably, there is little reason why the RBI should immediately move or sound dovish. To that extent, we have had this call for a very long time now. Sometime end of last year, we had put out the call that the first rate cut for the RBI, the opportunity for the first rate cut will come only around October or December policy. We continue to stick with that call that the RBI will act possibly or possibly have the first instance of a rate cut arises only in the December policy. So we are not changing that. And I think the kind of risks that we are seeing in terms of the food inflation, it's clear that the RBI will remain concerned regarding the 4% inflation target. And of course, we have to put it in context that the growth continues to be as steady as it has been. So that's where we are.
Okay, Rajni, I'd like to quickly request for your view as well on when you are anticipating the first rate cut. October seems to not be on the cards, possibly looking at the current growth inflation trajectory. But do you think there are greater chances of the first rate cut in the current cycle taking place in December?
So, Pallavi, we are also expecting a rate cut most probably in December. But our view is a little different. I don't think by December, RBI will be able to achieve 4% inflation target on a durable basis. So that still looks very difficult to me. But I feel that if food inflation moderates, RBI may still cut the policy interest rate, even if the overall CPI inflation remains above 4%.
Okay, all right. Let's shift focus to the IIP figures. So it's, while the IIP print does appear to be fairly strong at 5.9% for the month of May, manufacturing actually continues to lag in comparison. Mining has grown by about 6.6%, while manufacturing has grown by 4.6%. And we're seeing electricity having grown by 13.7% for the month. So, Subhadeep, what are your views on manufacturing also in context of the upcoming budget, and given where we're seeing manufacturing at, do you think that thematically the government might announce more measures by way of more PLI schemes or in any other format for which are specifically targeted at manufacturing?
So first of all, when we are looking at the IIP numbers, yes, they are strong. I mean, stronger than what was expected. So I think that's a good print to start with. Specifically, electricity production being higher, I think that's also to do with the month that we are in, May, the kind of heat pattern that we've seen. And in terms of the manufacturing, I don't think particularly it is a very weak number, because seen in context of the last few months data, I think that kind of trend we have continued to see manufacturing has never shown a very large increase or spike of that sort. And if I remember correctly, the April number was close to 4%. So we are in line with what we have seen over the last few months. And I think I would not particularly say that it's a very weak number or something. Yes, of course, it can be better. But we also have to keep in mind that when we are talking about the budget specifically, there are already the PLI scheme which has been put out, which does not necessarily have to be part of the budget. The PLI scheme is ongoing. Various sectors are seeing biddings happening in terms of the companies. Some of the capex is already underway. So I don't think particularly that there has to be a manufacturing focused push through the PLI in the budget per se. Of course, tweaks and all can happen through the year. I think more importantly, if you are looking at manufacturing, I think it's more to do with the ease of doing business and the regulatory, the legal environment, compliance, etc., availability of labor, and availability of quality labor. Those are the things that are more important for the manufacturing sector than through the budget, where maybe some kind of financial help or fiscal allocation. I don't think that is needed per se from a budget perspective.
Okay, all right. Rajni, coming back to you then. Given that we are a few days away from the upcoming budget, what are your expectations? And also added to that, what are you making of the economy at this point in terms of momentum? We are expected to see a little bit of easing in growth for the full year compared to the last fiscal. But would it be fair to say that economic momentum remains intact?
So coming to your first question first, as far as budget expectations are concerned, a few things I would like to highlight. First, I think the government will continue with the focus on capex that we have seen in the last few years. But I think overall, the YOY growth in capex would be around the same as what they had given in the interim budget. I don't see any increase beyond that. Secondly, I also feel that the government will continue the focus on fiscal consolidation, which again we have been seeing in the last few years. So that's going to continue. Thirdly, I think this time there is also scope for government to also increase the revenue expenditure. The ratio of revenue expenditure to total expenditure could increase a little this time. Because there is need to boost consumption. There is concerns around, what's happening to the agri and rural sector. So there could be increased allocation towards those sectors. There are concerns around the employment generation. So the government is likely to focus on labor-intensive sectors. So broadly, we can expect increased allocation to some of these sectors, labor-intensive sectors, and some of the welfare schemes focused on these issues. So broadly, these are the areas I think on which the government will focus. I think another important thing which the government should be looking at is how really to boost consumption. Because so far, if you see, the government has not announced any direct measure to boost consumption. And I don't think they will do that in the upcoming budget also. But I feel that is required, and maybe the government should look at giving a stronger push to consumption boost in the economy, because that will also ensure that private investment picks up, which is at the moment lacking. The other question as to what's happening to the economic momentum. I would say that yes, we are expecting some moderation in growth in FY25 compared to FY24. And we also have to see as to where this growth is coming from. I would say while the overall, 7% growth number is good, if we achieve that in FY25, we still need to worry about weak consumption and relatively weak private investment.
Okay, all right. Thank you so much for that, Rajni and Subhadeep. IIP numbers surprise on the upside, while inflation also proves to be a little bit of a surprise, coming in a tad higher than estimated.